Hello there, I hope that you are doing well. During today's lecture, I will discuss balanced price ranges with you. Understand the true reason why PD arrays work. Many people seem to believe that the markets are driven based upon PD arrays and that PD arrays are the reason why price goes up and down. However, what I want you to understand is that PD arrays are simply algorithmic signatures which take place based on specific price levels. When you understand balanced price ranges, you can let go of the majority of the PD arrays because all PD arrays are based upon the understanding of balanced price ranges. That is what we will discuss during today's lecture. The table of contents for this lecture are as follows. First of all, we will be paying attention to the PD array matrix. Secondly, we will discuss balanced price range, BPR theory. Thirdly, we will be paying attention to imbalanced price ranges as draws on liquidity or points of interest. Fourthly, we will be paying attention to the logic behind your favorite PD arrays. And finally, we will be looking at some examples. Here you can see the PD array matrix as created by ICT. Everyone that has ever stumbled upon the Inner Circle Trader, his YouTube channel, is familiar with this schematic right here, where you can see all the PD arrays which he has created. In the premium side right here, in this red box, you can see the premium arrays, and in the green box, the discount box, you can see the discount arrays. What I want you to see is that it begins with an old higher low, then the rejection block, the bearish order block, the fair value gap, the liquidity void, and the bearish breaker and bearish mitigation block for the premium side. For the discount side, this sequence is inversed. Now, what I want you to understand is that if you understand the majority of these PD arrays, what they look like, you'll be able to get a deeper understanding of why they work, because they work based upon balanced price ranges. Let us take a look at the word balanced price range. We're going to put emphasis on the word balanced first of all. What I want you to see is that I've made a description of what balanced means. Balanced means when there's an equal amount of two things. In this case, 2 times red and 2 times green. If there would be less red or less green, it would mean that there would be an imbalanced price range. Let me show you. If we would see 2 times red, but only once green, this price range would be imbalanced, meaning there's more red than there's green. You might be thinking to yourself, how come that this right here is so important to understand? Look, what I need you to know is that when you're looking at the market through the lens of algorithmic price delivery, it's very important that you understand that algorithms are seeking to deliver price efficiently in a balanced and effective manner. Meaning, they are looking for both buy side and sell side to be delivered an equal amount of times. If there is 2 times sell side delivery in red and 1 time buy side delivery in green, there's an imbalanced price range. Therefore, more buy side has to be delivered into that price range for the price range to become balanced. That right there is the underlying understanding of balanced price ranges, which you need to understand. And if you did not get it the first time listening to my voice, I want you to re-listen to what I just described. Because if it clicks for you there, within that 30-second part, I'm telling you, you're never going to be looking at the market through the same perspective again. Because once I understood balanced price ranges, my whole perception about the markets changed, even across ICT's concepts. Now, what does the imbalanced price range look like schematically, you might be wondering. Here we can see that I've drawn out a range high right here and a range low, represented by these blue lines. Inside of this range, you can see that price initially goes lower, then it goes higher, and then it goes lower and breaks through the range low. What I need you to understand is that when we break through this range low, there's an imbalanced price range present, especially when we display through it with a CB, represented by this box. Why? We see once sell side delivery, think about the red box. Then we see once buy side delivery, think about the green box. Then we see sell side delivery again, think about the red box. So you have seen 2 times sell side delivery now and 1 time buy side delivery. This means that buy side has to be delivered again in order to make this overall price range balanced before the market is allowed to expand into the anticipated direction. Now you understand why retracements take place. And now for the people that come from a support and resistance trading style background, the reason why our support turn resistance ideas work is due to this signature right here, where there is a CB, a bearish fair value gap, which displaces through this low right here. The market will seek to offer buy side into that very specific low, the low of the overall imbalanced price range, before it is allowed to expand towards the draw liquidity. So to summarize, what we are looking for is we are looking for sell side, buy side, sell side. Now we have 2 times sell side delivery and only 1 time buy side delivery. Buy side has to be delivered once more before sell side is allowed to be delivered further. That right there is a balanced price range. Now, if we are paying attention to a bullish example, it would look like the following, where we can see a range low and a range high. The market offers buy side towards this high. It then offers sell side. And it then offers buy side trading above this high. And whilst it trades above the high, we see a BC, a bullish fair value gap, get created. And now we will be looking for the market to retrace into that bullish fair value gap, into that old high, because that is where we can anticipate true resistance turn support ideas to work. The reason why is because when this move towards the downside occurs, sell side is delivered again before the market is allowed to expand higher. Why? Because we offered buy side twice, right here, sell side once, so sell side has to be delivered again, sell side gets delivered, and by this repricing lower, that sell side is being delivered, and the moment the price trades away from that range, and it does the movement away from it, that is when the price range has become balanced. Meaning, this repricing lower is not the balancing of the price range yet. The price range becomes balanced the moment that price leaves the range. And that is why I'm putting so much emphasis on the word leaves the range. Imbalanced price ranges can function as draws on liquidity. In this example, what you can see is that the market expanded towards the downside and it displaced through this old low with a CB. We expanded lower and we eventually formed a low. The market then began a buy program and we begin to see discount arrays, BCs, function as support on price. Notice that the market displaces higher and a new BC gets created. Market retraces into that and then expands higher. It reaches the draw liquidity of this old low. This old low was the low of an imbalanced price range. Why? Because we offered sell side, buy side, sell side through the low with a CB. So now buy side has to be delivered again into that range before the market is allowed to expand lower. We see the market form a high there and then begins to draw lower eventually. Why? Because imbalanced price ranges can also function as a point of interest, meaning you can look to buy the market into the imbalanced price range, and when the imbalanced price range gets reached, you can anticipate a reversal to form for the market to continue its bearish order flow. Imbalanced price ranges as draws on liquidity and points of interest again. Here we're looking at another example, and what I want to see is that the market expanded towards the downside. It formed this low. We then saw a retracement taking place, and the market then began expanding towards the downside again. We displaced through this low with a CB. What I need you to see is that eventually the market forms a low and it then displaces above this CB on the left side of the curve. Notice that this candle closes above it and the next candle opens up, drops lower into that CB, and that CB functions as an inversion for value gap. We see the market displace above this CB and the next candle opens up, drops lower, offering sell side into this CB before expanding higher, drawing towards this old low, the low of that imbalanced price range. We will discuss later during this video why this signature right here is also working based upon balanced price ranges. Because it's not just, oh, a CB gets closed above and then the next candle offers sells it into the CB and then we can expand and that's an inversion to value gap. No, the logic goes way deeper than that. We see the market expand towards that old low, and when it reaches this low, this is where we see true support turn resistance work. Why? Because the market is being repriced into an imbalanced price range, and notice how the bodies keep on closing around that old low, around that red line. Now you know why this is such a key signature, and when you start paying attention to this, you'll be mind blown by how many times it's occurring and it has been hidden in plain sight. Understanding inversion for value gaps. Now, nowadays, many people trade based upon inversion for value gaps. They're looking, for example, for a CB to get displaced through by a BC, and they buy the retracement into that BC. That right there is how the majority of people understand balanced price ranges. The same for the bearish side, where we see a BC get displaced through by a CB, retracement, shorter retracement. That is the overall thought process. However, let me explain to you why inversion value gaps work. Because the majority of people are looking for this price pattern, but they do not understand the why. And guys, understand the why is what matters. Like, if you are purely looking for price patterns for the sake of looking for price patterns, you're just trading based off any price pattern basically. But you need to understand why the price pattern should work and when it should work. And that right there is what matters. So the reason why inversion value gaps work comes down to balanced price ranges, as you already guessed probably. What we can see is that sell-side delivery takes place. During this sell-side delivery, a bearish value gap gets created, a CB. There's a lack of buy-side delivery inside of this range. The market displaces through this CB with a bullish value gap, with a BC. That's interesting, right? There was initially a lack of buy-side delivery during this leg lower, and now there's a lack of sell-side delivery during this leg higher. Therefore, we must see sell-side delivery take place into the newly created bullish value gap before the market is allowed to expand higher. And that right there is why your bullish inversion value gaps work. It has to do with understanding that the imbalanced price range has to be rebalanced before the market is allowed to expand. And notice that this doesn't have to be a deep retracement towards the lower end of that bullish value gap. It could also just be a retracement into the high of that bullish value gap, institutional order flow entry drill, and then we could see the expansion taking place. What matters is that sell side is being offered into that imbalanced price range. Now for the bearish side, it would look like the following, where we can see that the market expands higher and a bullish value gap gets created. The market displaces through that bullish value gap with a bearish value gap, with a CB. And what is occurring here is the following. We initially saw a lack of sell-side delivery during this leg higher. That is why the BC got created. We then saw a lack of buy-side delivery during the leg lower. That is why the CB got created. The market has to retrace into that CB to offer buy-side once more to balance out this price range before it is allowed to expand towards the downside. That is why your inversion value gaps work the way they do. Understanding breakers. Every time when I ask an ISST student why a breaker works, they always begin to explain the pattern to me. They say the market expands lower, they form a low, a high gets created, we see a lower low get created, then a higher high, and the moment that the retracement takes place, price is going to find support inside of that old high. Or if bearish, we would see an expansion higher, a high creation, low formation, higher high, lower low, retracement into the low, that's your bearish breaker, and now we should see an expansion towards the downside to take place. That right there is what everyone answers to me when I ask them, what is a breaker block? But here comes the thing. Do you understand that that's simply the explanation of the price pattern itself, but it's not the underlying logic behind why it works? If we begin to look at breakers through the lens of balanced price ranges, you will see the following. You will see that we offer sell side, and we then offer buy side. We see the market offer sell side, and we see it offer buy side again. Now you would think to yourself, but hey, we have offered sell side twice and buy side twice as well now. Now we can anticipate this range to be balanced, right? Here comes the thing. This leg towards the upside is not balanced yet, because what forms during this expansion leg towards the upside? A BC, a bullish fair value gap. So the market has to retrace over sell side into that bullish fair value gap, into that old high, into that bullish breaker, and we can then anticipate the market to reprice towards the upside. So we reprice lower, and the moment that we leave the price range, it becomes balanced and we can anticipate the next expansion leg to take place. For the bearish side, it would look like the following, where we would see the market expand towards the upside. We see sell side delivery taking place, buy side delivery, sell side delivery through the old low, buy side delivery, and you might think to yourself, why does this move higher occur if we already offered buy side twice here, and sell side delivery twice here and here? Because during this leg towards the downside, a CB, a bearish value gap, will form. So IPTA will seek to offer buy side into that CB before it's allowed to expand lower. But here comes the thing. True breakers form inside of a very specific array on the left side of the curve. That array is an imbalance. If we would look at the bullish breaker first, you would see that the bullish breaker forms inside of this blue box. This blue box is a bearish value gap. This is your CB. The fact that we have a lack of buy side delivery during this expansion towards the downside means that we have to offer buy side into that CB again. We see the market expand lower, and we then see buy side get delivered. We see an expansion leg higher taking place. During this expansion leg higher, we see the market create a BC. This right here is the market structure shift pattern as I've coined it 2 years ago on my public YouTube channel, where I shared to you CB, high inside of that CB, followed by displacement through that high with a BC. That right there is the strongest reversal signature out there. And it occurs across all markets, across all time frames. Now you might be smiling because if you are paying attention to this lecture, you would see that this market structure shift pattern is based on balanced price ranges. But not only one balanced price range, now the two variations of balanced price ranges as I lined them out during this lecture, where we see CB, BC, and we see the formation of a bullish breaker right here, but also the high getting displaced through with a BC. Right, Bob? Yep. We are aligning all those signatures with each other because that way we know that this is a very strong reversal signature and that the market is likely going to retrace into that high before expanding. Now for the bearish scenario, what we would see is we would see an expansion towards the upside, and during this leg higher, we of course see buy side delivery taking place and a bullish value gap gets created. The market will seek to retrace into that bullish value gap, and when it forms a low here, we can anticipate one more leg of buy side delivery to take place. The market takes out this high, it reaches our higher time frame key level, and then it begins to displace towards the downside. We see sell side delivery next. A bearish value gap gets created, and the market will seek to retrace into that bearish value gap before being allowed to expand lower. This right here is the bearish market structure shift pattern. If you begin paying attention to this reverse signature, you'll be mind blown by how many times it occurs. This is the part where you need to put in the work. I've provided you with key algorithmic signatures that you can look for inside of the delivery of price, and I've also shared with you what they look like. And when you begin to search for these algorithmic signatures, it doesn't take long for you to see them over and over again. If you do see algorithmic signatures that I've taught repeat over and over again, please let me know in the comments, because that right there would make my day. Because I hope that I'm able to share with you what I see within these markets. I want to thank you for watching this lecture all the way to the end. I hope that you have gotten a good understanding of balanced price ranges now. If you haven't yet, I would highly suggest you to rewatch this lecture because it is literally explained to the best of my abilities. I want to wish you all the best in your studies and I look forward to catching up with you in the next lecture. Be safe.